Hello traders, welcome to the fifth module of the Advanced Technical Analysis course, Trending Indicators. In this video, we're going to teach you all about moving averages, what they are, and how to use them in your charts. So let's start. What are moving averages? Well, moving averages are trending indicators that are displayed as a line in your chart following price. This line represents the average price of an asset over a specified period of time. If we take, for example, the 15-period moving average, the indicator will plot the average of the closing price of the last 50 candles, which are periods, and it will look like this. As you can see here, we are in not a very steep up move, but if we plot the 50-period moving average, you can see it as a black line here on your charts. Now, there's something you need to know about moving averages. You can choose the 50-period moving average as well as the 100, 200, and even the 1-period moving average. And the more periods you use to calculate moving averages, the slower it will react to price. This means that a faster moving average, and when we talk about faster moving average, we are talking about moving averages that use less periods to calculate the actual indicator, are going to react faster to price. Now, here's an example of the same chart using the 50-period moving average, which is the black line that you have here, and the blue line here is the 9-period moving average. As you can see, the moving average with the less periods used to calculate it is reacting faster to price and is following price closer. Now, this doesn't mean that it is more reliable. In later lessons, we are going to show you how to use different types of moving averages and actually how to use a two moving average combination to get signals. But in this lesson, we are just going to teach you what they are and actually how to plot them and use them. So we already saw that the more periods you use to calculate the moving average, the slower it is to react to price. Now, the first use for the moving average are to spot the current trend and its strength. When the moving average points to the upside, we are in a bullish market, just like in this example. And again, this is the 13-period moving average that is following price. And as you can see, price is trading above the moving average, and the angle of the moving average is very steep. So we are in a very strong uptrend at the moment. And when the moving average points to the downside, we are in a bearish market. And of course, the steeper the angle, the stronger the move. And as you can see, price here is trading below the moving average. And even if it fakes out a little bit, it continues to dip to the downside. And the moving average gives you the overall strength of the move down and the strength of the correction. And as you can see, the steepness of the correction is much lesser than the steepness of the move. So we know that we are not in a reversal, we are just correcting before continuing to the downside on a small correction to the upside. Now, there's a couple of things you need to know. When the moving average is flat, we are in a range market or a range bound market or in a chop, and moving averages don't work in ranging markets. If we are in a ranging market, we are not going to use moving average in our charts because they will give you too many fake setups. Now, the other use for the moving average are as support and resistance. When we are in a bull market, we will be looking for support zones to jump into the trend, and just in this case, or well, this is the same example as before. You can see that we are in an up move and then we correct a little to the downside. Here we have a red candlestick that rejects the moving average and continues to the upside. And even if we came back and retested again, the overall move continues, giving us a great entry on a great risk to reward ratio setup right here at this zone. Okay, so When we are in a bull market, we are going to look for rejections of the moving average as support, and when we are in a bear market, we will look for rejections of the moving average as resistance. And in this case, we already said that even though we are in a down move, here this fake out counts as a correction, and of course we don't continue to the upside, and when we cross back below the moving average, we have an entry to go short on this asset. And as you can see, the risk versus the reward on this trade is amazing. Now, these sorts of rejections to the moving average can give us entries to get into the move. And remember this, when the moving average is flat, we are in a range or in a chop. And if we are in a range or in a chop, we are not going to be using moving average because we are not trending, so we are not going to be looking for support or resistance areas. Our rejections to the moving average as support or resistance if we are not trending.